Most financial advice centers on a single, bulletproof strategy. Funnel as much money as possible into pre-tax accounts and let compound interest do the work. The math of traditional IRAs and 401ks carries a strict structural liability. Every dollar inside those accounts is pre-tax, meaning you effectively co-own that capital with the government. When you withdraw a dollar, you pay ordinary income tax on it. You are delaying the tax calculation to a future date, betting that your tax bracket will be lower in retirement. If brackets rise, or your accumulated wealth forces you into a higher tier, you create a massive future tax burden. This chart shows the long-term trajectory of a standard retirement account. Eventually, the IRS steps in with required minimum distributions, or RMDs. These mandates force capital onto your tax return, regardless of market conditions. That burden accelerates sharply when one spouse passes away. The surviving spouse inherits the entire IRA, but is forced to file as a single taxpayer. This creates the widow penalty. The exact same RMDs are taxed at higher, compressed rates, draining the remaining capital. When that capital passes to the next generation, the rules tighten further. Under current law, non-spouse heirs must completely empty an inherited IRA within 10 years. Distributing a lifetime of compound growth over a compressed 10-year window pushes heirs into the highest possible tax brackets. The standard pre-tax accumulation method engineers a compounding tax liability that actively erodes multi-generational capital. To prevent this erosion, wealth strategists look for mechanisms to legally sever the link between capital growth and tax liability entirely. The blueprint for this severance is found in Internal Revenue Code Section 7702. Section 7702 defines what legally qualifies as a life insurance contract. If an account meets these precise mathematical requirements, its internal growth and subsequent distributions are fully exempt from income tax. Most people purchase life insurance strictly for a death benefit, paying premiums to protect against early mortality. High net worth strategists invert this structure. They minimize the death benefit to the lowest legal limit and maximize the cash injected into the policy. This inversion is typically executed using one of two specific vehicles: Indexed Universal Life, or IUL, and Participating Whole Life. An IUL credits interest based on the performance of a market index, while Participating Whole Life pays dividends from the profits of a mutual insurance company. Mutual companies issuing these policies have maintained dividend payouts and protected principal through severe economic distress, including the Great Depression. While the broader market experiences severe drawdowns, these properly structured insurance contracts act as a firewall against capital loss. By prioritizing cash value over the death benefit payout, you construct a high-yield, highly liquid asset that operates outside the boundaries of the standard tax system. The mathematical objective of these policies is precise: inject the maximum amount of cash possible to accelerate compound interest. This chart illustrates the primary regulatory hurdle. The IRS imposes a cap on how much cash you can deposit relative to the size of the death benefit. This ceiling is called the Modified Endowment Contract, or MEC, limit. If your cash contributions breach that MEC limit, the policy loses its 7702 tax privileges. The IRS reclassifies it, instantly stripping away your tax-free accumulation and withdrawal status. To understand why most policies fail as wealth vehicles, look at option A, or a level death benefit. In this standard structure, the insurance payout remains completely static. Because the death benefit is locked, the MEC limit is also locked. Aggressive cash deposits will rapidly force the cash value into that static ceiling, triggering the tax penalty. Roughly 90% of policies written today are constructed this way. Agents solve for the face value of the insurance rather than the cash accumulation needs of the client. A rigid Option A contract strictly limits how much capital you can inject. It functions fine for basic life insurance, but it is mathematically useless for capital accumulation. To fix this, financial strategists apply a specific actuarial lifeification. They structure the policy using Option B, known as an increasing death benefit. Under Option B, the total death benefit is mechanically tethered to the cash value. As you deposit more capital, the death benefit automatically scales up to absorb it. This tandem upward movement maintains a precise gap between your accumulated cash and the total insurance payout. The IRS requires this gap, known as the corridor, for the policy to remain legally compliant. Because the death benefit continually adjusts to maintain that corridor, it perpetually pushes the MEC limit higher. You can now inject massive amounts of capital without crossing the threshold. This Option B structure is highly specialized. It is typically maintained only during your working years, actively absorbing heavy capital deposits while you build wealth. Activating Option B removes the artificial cap on your contributions. It transforms a restrictive insurance contract into a dynamic, expandable tax-free vault. This strategy often faces a specific critique from mainstream financial commentators. They argue that holding permanent insurance into old age guarantees exorbitant internal fees. The claim is that the annual renewable term, or ART, the internal cost to insure your life, will skyrocket as you enter your 70s and 80s, eventually depleting the policy. While true for poorly designed contracts, this is a fallacy when applied to a properly structured policy. Dismantling this misconception requires looking past the total death benefit and examining a metric called the net amount at risk. Look at this ledger data for a properly structured policy at age 80. The top-line payout shows a total death benefit of $1.1 million, but look directly adjacent to it. By age 80, years of max funding and compound interest have grown the accumulated cash value to $1.05 million. The carrier is not charging insurance costs on $1.1 million. They only charge you for the difference between your accumulated cash and the final payout. That $50,000 gap is the true net amount at risk. The insurance company is strictly on the hook for that $50,000. Because fees are calculated only on that shrinking margin, the cost of insurance plunges as you age, allowing your capital to capture maximum yield with almost zero internal drag. Once the accumulation phase establishes that heavy cash value, the strategy shifts toward deployment and liquidity. Traditional retirement accounts force a binary choice: leave the money invested to grow or liquidate the asset to spend the cash. You cannot do both simultaneously. Max-funded policies bypass this limitation. To access cash, you never withdraw your baseline capital. Instead, you utilize it as collateral. You request a policy loan from the insurance carrier. They hand you an advance from their general fund, using your accumulated cash value as legal collateral. Critically, your original capital physically stays inside the account. It remains completely intact within the tax-free vault. Because your money remains in the policy, the carrier continues to credit you the full dividend or index return on the entire gross amount, straight through the duration of the loan. Collateralization ensures that your compound interest curve is never broken. The math allows the exact same dollar to perform two entirely separate functions at exactly the same time. The final step of wealth creation occurs when you deploy that collateralized loan into a secondary investment. Every policy loan carries an annual interest rate set by the carrier. For our math, we will use a standard cost of 5%. You take that borrowed cash and inject it into a heavily cash-flowing external asset, like a commercial real estate property. That real estate asset generates its own revenue stream, yielding a 12% annual return. You use that yield to service the 5% loan cost. The difference captures a clean 7% spread, known as positive interest rate arbitrage. You are capturing that 7% real estate spread concurrently, while your original principal continues to earn its uninterrupted, tax-free yield inside the insurance policy. When engineered correctly, permanent life insurance ceases to be a mortality product. It functions as a verifiable, tax-free liquidity engine designed to stack multiple layers of compounding growth onto the exact same pool of capital.